Hey, what's up, my friend? So, in today's episode, I want to share with you 5 things to look for before you exit a trade. Number one, the first thing to look for is to ask yourself, what is the goal of a trade, right? Because depending on the type of trader you are, you could be looking to capture a swing in the markets, or you could be a trend follower looking to ride a trend in the market. So the first thing that you must do before you exit your winning trade is to determine what type of trade this will be. Is this a trade about just about capturing one swing, capturing one move in the market, just one move, or is this going to be a trade to ride trends in the market where you're willing to accept the ebb and flow of the market, to embrace the drawdown, the pullback that comes along the way, with the hopes of riding a trend. So that's the first thing that you should look out for, right? To ask yourself, is this a trend following trade, or is this a trade to just capture a swing? Number two, if you are looking to capture a swing in the markets, right, that what you want to pay attention to is swing high and lows in the market, support, resistance. So for example, let's say you are a swing trader, you want to capture a swing and you happen to buy at support, market is moving in your direction. So at what point do you exit your trade? How do you exit your trade such that you can actually capture a swing in the market? So my guideline to you is that if you're a swing trader looking to exit your trade, right, then you want to place your exit at a level where, or rather at a level before opposing pressure sets in. So if, for example, if you buy at support and the market has moved in your favor, you want to ask yourself, where might opposing pressure come in? Or in other words, where might selling pressure come in? Where might sellers step into the market and push the price down lower? And a few common levels to pay attention to is swing high, area of resistance. I would say these two are pretty much the most common ones. So if you're a swing trader, pay attention to support, resistance in the market, pay attention to swing highs and lows, because this is where opposing pressure is likely to step in. Number three, if you are a trend follower, then what you want to look for is to use a technique that allows you to ride a trend. So there are many techniques out there, but generally, when you want to ride a trend, right, you have to embrace, watching your winners become losses. That is just the fact of trend following. It's impossible to ride a trend without having the willingness, right, to endure the drawdown, to endure the pullback, right, that is guaranteed to occur in every trending market. So you want to adopt a trailing stop loss. What this means, right, is that if the market moves in your favor, then you want to progressively shift your stop loss higher, right? So your trade, right, still has that that wiggle room to go up and down, right, without stopping you out for a loss too early, or rather without stopping you out of the trade too early. So there are numerous trailing stop loss techniques that you can use. Some of the more popular ones are, for example, if you're a discretionary trader, right, you can use the price structure of the market to trail your stop loss. For example, if you buy a breakout, market moves in your favor, how do you know when to exit, right, your trade, right, and you still want to capture the uptrend? So what you can do is, as the market moves higher, you would expect to see a series of higher highs and higher lows, like up, down, up, down. So what you can do is you can trail your stop loss, right, on the previous swing low. So as the market continues to make a series of higher highs and higher lows, you will continue holding that trade. But when it breaks the previous swing low, that's where your uptrend, right, sort of got destroyed. The pattern is kind of like no longer how an uptrend should look like. So that's when you can exit your trade, and hopefully, right, the trend has moved enough in your favor where you can actually capture still the mid, right, of the move. Okay, so that's the third thing, right, using a trailing stop loss. At the same time, you can also use things like moving average, or chandelier crow stop, and stuff like that. Number four, you want to pay attention to exiting your trades based on emotions, because this is usually when you are exiting your trades, right, at the worst possible time, when you can no longer take the pain anymore. Because let's be honest, right, whenever you exit your trades, right, most of your losing trades is usually because you can't take the pain any longer. The market has moved against you so much that you don't want to endure the pain anymore. You want to call it quits. Enough. I'll just bail off the trade. And then what happens more often than not is that you pretty much sell near the lows and the market rebound higher. So be aware, right, of exiting your trades based on emotions, because when the market moves in your favor, you are usually pretty confident. You don't have the incentive, the feeling to want to exit your trade. The emotions, right, that cause you to want to exit your trade usually is when the market moves against you. So a very quick fix, right, is to ahead of time, right, predetermine, right, where is your stop loss level. Predetermine, right, ahead of time, right, where will you get out of the trade, right, if the market moves against you. Because once you have defined that level ahead of time. Once your risk management, your position sizing is all based on that level. If the market moves against you, so what? You're already prepared for it. So this way, you will not be, exiting your trades based on emotions, which is usually, right, exiting your trades at the worst possible time. So plan this ahead of time, right, even before you put on a trade. And the fifth and final thing that I have for you is before you exit your trade, ask yourself honestly, is this according to your trading plan? Because there's no point, right, exiting your trades, based on certain technicals and market, certain, guidelines that you have followed. But if that's not part and parcel of your trading plan, then it doesn't matter, because your trading plan is what matters. Your trading plan is what guides you to have a consistent set of actions. Because without a consistent set of actions, you will not get a consistent set of results. So your trading plan, right, is what gives you consistency if you follow it. So this is why you must develop your trading plan. You must, right, have the discipline to see through it, right, no matter, how difficult things are. Because if you can follow your trading plan on each and every trade, right, regardless of the outcome, I would say, well done, right? Give yourself a pat on the back, because you clearly, right, have what it takes, right, to become a winning trader, someone who can, follow their plan. And with, a consistent set of actions, you will eventually achieve a consistent set of results. Okay, so just a quick recap before we end. Number one, the 5 things to look for before you exit a trade. Number one is to ask yourself, is this trade a trend following trade or a swing trading trade? Number 2, if you're a swing trader, you can look to exit your trade before opposing pressure sets in. This could be levels like support, resistance, swing high, swing low, etc. Number 3, if you're a trend follower and you want to trail your stop loss, you can use it using price structure, moving average, etc. Number 4, don't exit your trade based on emotions, because this is usually at the worst possible time when the market is really at its maximum pessimism or maximum optimism. And I mean, usually the case, right? Not always, but more likely than not. And number 5, have a trading plan and follow it closely. Okay, and you want to dictate your exits, right, based on your trading plan and nothing else, not the news, not the opinion, not the noise of the market. So with that said, I wish you good luck and good trading. I will talk to you soon.